Investors and traders, welcome to the channel. Today is 13th of July 2024. I hope everyone is having a great weekend. I wanted to do this video about the US stock market and the key US markets that we take a look at in our weekly analysis and also for the daily analysis segment. But the weekly analysis segment actually becomes quite long, so I just wanted to do a video so that I could split it and we could talk about some of the really interesting looking charts, and then I'll have more time to dig more deeper into the US stock market sectors, for example, which is a video I will do tomorrow, so Sunday, 14th of July. And I'll try to cover some of the markets such as the bond markets. We'll also take a look at the US dollar also from a longer term perspective, and we'll also take a look at some really interesting charts. As always, this video is for educational purposes only and it is not a financial advice. So we'll start by taking a look at this chart which I constructed. So what you are seeing is a long-term chart. This is a quarterly chart where each candle represents 3 months of activity, and what you are seeing is a ratio. It is a ratio of SOX, which is the semiconductors index, and it is divided by the HUI, which is the gold bucks index ratio. And something really interesting is coming out of this picture, and I'll also discuss why I wanted to show it to you. So one of the things that we have seen is the highest print that we saw for this ratio was back in July of 2000. So that was about 24 years ago, and as we know that was the era of the internet and the dot-com era, and also the Fed funds rates were above 5%, and there then of course what we also know is that the dot-com bubble actually burst, and we saw a huge decline with respect to this ratio. So what happened was that actually uh, when the money started to come out of some of these really high profile tech stocks, really hot tech stocks, then maybe some of the boring things such as the gold miners started to get bought, and we saw a rise in that, and this is what we see happening around here. And now really interesting is that this is actually, this index, this ratio that I've constructed is actually making a high which is very close to the all-time highs reached. And what is going on is actually quite similar as well, because we are in the blockchain and AI environment. So it's the blockchain and AI era, and of course the Fed fund rates are also greater than 5%. So it looks like I will be doing a segment about gold tomorrow, that some of these gold miners that have been just kind of long forgotten, because they have been in a bear market for about 10 plus years, 12 years, 14 years in some cases. Maybe they're about to get some life coming back into them if we see in future, I don't know exactly when, some rotational aspects happen in the market, and the money begins to rotate out of certain kind of sectors, certain kind of stocks. Maybe it begins to find way into some of these gold stocks. So this is what this chart is actually going to be very helpful in letting us know. Now we move on to another really interesting thing that I wanted to show you. And here what we are looking at, this is the NAAIM, which is the National Association of Active Investment Managers. So these are managers which take exposure to the US equity markets, and these guys also use leverage. So before I actually move deeper into it, just let's take a look at their legend here. So they have a range here, and what it means is when it is minus 200%, then it means the leverage is a leverage short. Minus 100 means fully short. 0% is 100% cash or hedge to market neutral. So these participants, these money managers, active money managers, have actually become neutral in the market. 100% is fully invested and 200% is leveraged long. So that's how this legend works. Now if we just come back here, and just something really interesting that I wanted to show to you. So here what we see on the right hand side here in this blue chart, we see the dates here and we see the average here. And if we just look at the way this is constructed, we have the bearish, we have the bullish around here. We can see that these managers have been really bullish. 200 in reading is actually leveraged long, so they have been really leveraged long. And something really interesting happened in the reading on the 3rd of July chart, excuse me, the date for that week when this was compiled. The average actually went above 100. And look at the bearish column is zero. So there was just no one who was bearish. This is really interesting. Now if we move over to the chart here, this is the index on the top, and then this is where we have the actual S&P 500 at the bottom. Let me actually move it a little bit higher so it's going to be a little bit easier to see. Now what we see is that this is the line which indicates whenever this index has gone at or above 100. So in this recent data, what we see is the last time it happened was in July 2023, and we saw the market actually put in a top, and then it went into a correction which lasted quite some time. Now, something really interesting, which we'll just talk about it in a little bit later on. And here, then we have a second reading coming in on 27th of December 2023. The market had a little bit of a wiggle or sideways. In fact, our timing model also picked it up. And this is more recent, 13th of March 2024, and this is 27th of March 2024, and we saw a correction in the market. I believe in S&P 500 was about 5.5%, 5.6 percentage points, something like that. Now the really interesting thing is that because this is actually a election year, so in 2023 we did see a multi-month correction take place. I believe it was because the expectation for a rate cut were pared back by the Fed, but they kind of did a pivot around here in November, and we saw the market just really shot up. But the another really thing is more about cycles, and the thing is that there is a 4-year cycle which coincides very well with the presidential cycle, and since this is a election year in 2024 in the United States, the most juicy part of that presidential cycle is about 18 months prior, and this is what we see that in October 2022, the market actually put in a bottom. That was the end of the bear market 2022. Now the professional money managers or these participants who actually watch these cycles, they are aware of it, and they looked at the macroeconomic data coming out, expectation with regards to the interest rates, and then they started to actually buy, and this is what we have seen. And then in October 2023 we see a market put in a bottom again. So now I don't know, based off this reading, it's not, in my opinion, easy to see that if it has much of a predictive ability, but we have seen that when it goes above 100, that is a key point to pay attention to, because it could be an anomaly, the kind we have seen here, that there was just no bearish bets at all. So what is possible is that over the course of next few weeks, we can see a fair amount of volatility come into the market, and in my opinion, that would be more of a rotational perspective. Um, and this is what we have seen over the course of last trading week. We'll discuss more about it in my next video tomorrow. And also from this chart going back around here, that is something also to keep at the back of our minds with regards to this. Now what I'll do is I'll actually move to the dollar index, and here I just wanted to show you something. Let's actually move to this really long-term chart. Here we go. So this is the dollar index chart going back several years. In fact, 1985 is the data where it starts for the trading view for this symbol. And here, something that I really want to point out is this concept of the market symmetry. So we have seen a dollar rally or a bull market start in 1992, and it put in a double bottom around here in 1995, and then this dollar just rallied for 10 years, and then we saw a big decline which culminated around when the great financial crisis actually started in earnest in April of 2008, and the dollar has in fact been in a bull market. But look at this, the top which came in July of 2022, if we just take this time in terms of symmetry, it's 12 years. So we have this market symmetry in the dollar index. Now, it's my opinion that we might have actually put in the dollar might have actually topped longer term because it came really close to the 78.6% retracement. Now, there is one chance that if we just look at when the dollar had put in a top in back in 2001, it did actually retrace quite a bit. So there is a possibility we could still see, huge retracement back up and challenging these highs, maybe even a little bit higher to 78.6% retracement. But if we look at this ABCD one-to-one price projection here, this is where it completed, and this is where we have seen in July 2022 the dollar put in a top, and then for several months it's just been down. In fact, it's longer than that because each bar is a quarterly bar, so each bar represents 3 months of activity. So now the quarter is not over yet, but this is the view that actually, in fact, the dollar might be longer term moving lower. Of course, the real key to this is this point here, 99. This is something I've been talking about a lot because that's the 61.8% retracement of the CD leg. In my opinion, if we move below this, and it needs to be convincing lows on weekly closing basis at least, we could in fact be in an ABC to the downside. So here we just remain range bound for several months now. There's a possibility perhaps it could actually retrace higher to challenge these highs, maybe a little bit higher. That possibility is there. But there's also a fair amount of evidence based on the symmetry and also these pattern formations that dollar might have actually peaked longer term. Okay, so this is something I just wanted to discuss as well. Now, just moving to shorter term. Here we go, and here this is the daily chart for the US dollar, and the pattern that we had been watching for was that we think, well, we have a double top formation here. So 107 is a pretty strong resistance level for the dollar. And now the dollar is moving in this ABCD one-to-one price projection mentioned in this black lines here. And the target is ultimately down here, 102.80. But it's going to find some sort of support when it reaches down to the lows of the 7th of June in 2024. It's really key if it's able to break below these lows. Otherwise, on the weekly chart, here we go. This is something which we discussed as well. Here we go. Put it on the weekly. Here we go. So if this low is held, there is a chance, although a weaker probability in my opinion, of this red ABCD being active as well. But the way the market has been trading sideways with 107 not being able to take out for several weeks, months now, the chances are actually we are heading lower, and ultimately will go and challenge this 99, which is the 61.8% retracement. So that's what we are looking at in terms of the US dollar. Now let's take a look at the shorter term 2-year Treasury note. Let me go back to the daily chart. This is what we have been looking at. Something really interesting happening last Friday we have the PPI data come in. I believe the PPI data was a little bit harder than what was expected, but we still saw the yields actually pair back or actually move lower, so the price went higher for the 2-year Treasury notes. This is shorter end of the curve, and something really interesting that we were watching for was this black trend line, and the price actually broke below it, which is another convincing aspect that in fact this ABCD, which is the black one-to-one price projection, is actually active. And this is what we thought it was, and when we were waiting for 4.7 to break to give us the confirmation, because that was the 38.2% retracement structural support around here. Now this can go as low as 3.9%, which should actually help risky assets such as the stock market. And of course, we are also seeing the yields move lower. We are also seeing the dollar move lower. And we saw precious metals such as gold move higher, and the commodities being neutral to higher at the back off the back of the lower US dollar. So that's the kind of macroeconomic picture that we had constructed for the summer of 2024. And in my opinion, that's the way the market might are likely to move till the end of September. So before the election scenario, but at least till the end of September is the kind of what I'm looking at for the summer months. Okay, so now let's take a look at the 10-year Treasury note. So we have that economic data come out, PPI. This one was also strong. Let's take a look at the ZB, which is the 30-year Treasury note. It was also strong, but still from the inside bar. Now the chances are it's actually moving in this channel formation here, so I wouldn't be surprised that 120.31 is an area where the market want to go, but it might actually find some resistance there because top of the channel also 61.8% retracement. So that's going to be the next hurdle for this market, but ultimately it looks like I personally believe that we are in this CD leg higher, and we can see much more improvement on the interest rate side on the longer end of the curve. But again, the market can get to maybe around 130, 132 and still be in a bear market with this massive ABCD one-to-one price projection completed. So really interesting what is going on. And let's also take this one, take a look out on the weekly chart. Here we go. So this is the weekly chart, and here we have the 38.2% retracement from the all-time highs to the lows, the recent lows of October 2023, coming around 138, 130, 139. And we also have the 200 day 200 week moving average just hovering around there. So it's going to be an interesting spot to look at if the market is able to get there. So really interesting what is happening now. Let's take a look at TLT, which is the ETF for 20 plus year duration um, bonds, treasury bonds. And here this market took out this swing high. Here we go, and now it's just pulling back. Here we go, and it's pulled back right into a 38.2% retracement and formed an inside bar. And now the chances are that it's likely to resume its rally higher. And if we just take a look at this on the daily chart, okay, I think I picked up something wrong here. Yeah, this is the one that should be looking at. So yeah, just like the 30-year futures CD leg, I believe we are in that. We had actually broken above the 92.40, but then we pulled back. We got nice support from this trend line around here. And on the weekly chart, here we go. Yeah, I think I picked up the wrong symbol. Excuse me. So here we go. It pulled back a little bit back into the range, but chances are we have this 89 period moving average right here. That might be the next spot, and ultimately challenge these highs of 100 and spot 60 and even higher, and then ultimately we have a lot of resistance at 108 or 109 level. So that's going to be an interesting spot to take a look at should the market get there. So this is what I really wanted to cover. I just wanted to break down the video so that we can focus more on some of the charts for the equity markets and also look at the sectors as well. So thank you very much for watching the video. Good luck, good trading, and speak to you soon.